I know how difficult it is to have so many Zoom calls and so much time in front of the computer. So the goal is to make it worth your time. There's going to be 3 areas that we're going to be covering, broad areas. One is going to be interest rates. We're going to also talk about the economy, and a part of that being what's happening with government debt and what's happening with taxes. And then the last part is going to be the stock market, and also common mistakes that, that investors make so that you can avoid it. And these mistakes are made both by professional investors and for the average person. So I am going to screen share. So interest rates have really 2 sides. Let me get into this. And we're going to screen show it, slideshow it, there we go. So if you're borrowing money, what you care about is you want to have low interest rates if you're borrowing, and if you're a saver, you want to have high interest rates so that you've got that you're making more money. And we're going to be using interest rates and yields kind of interchangeably with this. And it all starts really with the bond market. So bonds, for those of you who are not that familiar with it, because it's not really talked about that much, are basically just really large loans. So loans that are too big for a bank to make. You go to the bond market, so the IBMs of the world and Microsofts, although Microsoft doesn't really need a whole lot of debt. And then governments also will go to the bond market. So our government debt is managed through the Treasury Department. And so our bonds are called Treasury bonds. And over time, there's really 2 things that really have a big influence on bonds. One is going to be the demand, and the second is going to be what is inflation. If you're going to be making a loan to somebody, you want to make sure that the money that you're loaning out is worth as much as it is when you get it back as it was from the start, because inflation will eat away at your purchasing power. So we start here looking at historically the relationship between the 10-year US Treasury bond, so a bond, the government bond that matures in 10 years, and the inflation rate going back to 1953 through today. So it's not a one-to-one correlation, obviously, but it does have a close relationship. And we started in 1953 in this chart because we had such a large debt level at the end of World War II that the government instituted what is called financial repression, where they forced banks and insurance companies to hold a certain amount in their balance sheet of US government bonds in order to stabilize the market so that they could basically grow out of that high debt level, and gives the government time to pay that back. So we started this chart in 1953. So I always like to look at kind of a perspective on things. So, but if we break it down into shorter time periods, back in the 80s, we saw the peak, and we've seen declining yields basically ever since then. But the weird thing about this is that even though yields have been declining, we haven't seen inflation declining by as much as yields have declined. So that relationship, while still related, is not as strong as it had been. And you break it down to the time period since the financial crisis, and basically 10-year yields are barely keeping up with inflation. So it's a real departure from a historic standpoint. And I've seen reports that go back even much further than World War II in different markets. And it's a really unusual time. So we kind of question, well, what is going on? Is this, this isn't just COVID related. This goes back at least another 10 years, prior 10 years. And what can we expect that to mean for the future? And that's really where we tie in with the economy. So kind of looking at the economy overall, it's measured by gross domestic product. In the US, our annual GDP as of 2019 was $21.4 trillion. 70% of that is consumer spending. Between 16 and 17% is government spending and business spending. And then imports, exports, on a net basis, we import about 3% more than we export. So the real huge portion of our economy is really the consumer. It's not measured the way you would think it would be measured. what they're trying to do when economists are looking at this is that they're trying not to double count. So they're only looking, they want to try to capture what the end market demand is. And what I mean by that is that for businesses, it's really only your CapEx that's being included in the GDP. It's not your operating expenses. The way that this is measured is that your employees who get paid and then they spend the money, that's the end market. It's not you paying them, that's the end market. It's what they're doing ultimately with their income. Same is true for government spending. This isn't the full amount of government spending. This is what is the government spending on an end market basis. It does not include, say, Social Security payments, because in the way that this is measured, those Social Security payments go to the consumer and the consumer decides to spend them. It gets captured in that place. They don't want to double count. So government spending would be, healthcare spending is included in that because it is an end market spend. Military, so if we're building a new aircraft carrier, that would be included. Things like buying new computers or upgrading your software, all of that is included. But it's something to keep in mind. It's not a perfect measure of what we think, just as the layperson, of economic development. So if you've got such a large, let me go back to that. If you've got such a large portion of the economy that's tied to the consumer, we've seen with COVID about a 10%, actually at its peak, it was almost 15%, but right now it's about a 10% decline in consumer spending. With that being such a large portion, you have to have about a 30% increase in government spending in order to make up that gap. So that's one of the reasons why we're seeing the policies that have come out from the government has all been about how to get money back into the consumer's hands to keep spending, to keep the economy going and not have as much damage as would otherwise have happened. We didn't have that in the Depression, by the way. So, I mean, it is one of the reasons why it got to be so bad. You had government actually decreasing their spending, businesses decreasing their spending, and consumers decreasing their spending at the same time. And everybody wants to avoid that. So because we're spending so much more, we have a lot more government debt, and we're not alone. So if you look at across the globe, developed countries and developing countries have been trying to make up for this decline in demand from the consumer side because the economy is being shut down with trying to pick up that spending on the government side. So this, I'm not sure if you can see the right-hand side is where COVID kind of picked up. Now, so Japan has had higher government debt for a while. The rest of the world is kind of picking up to it. I included Singapore in here because Singapore is generally considered to be a pretty fiscally conservative nation. And even there, you've seen that pick up. And then the US. France haven't released their numbers yet for the last quarter, so we haven't included that. But Europe has that same kind of pickup at the end. Now, when I was in school in economics classes and finance classes, what we were taught is that if government spending increases and government debt grows, that it's crowding out private spending and you're going to see inflation. But we just saw from the previous charts that we haven't had to pick up an inflation as you would have expected, at least as were taught in theory, with the government spending so much. And so it's more than just government debt. So there's an economist by the name of Richard Koo. He grew up in Japan. He studied in the US. He worked here. We worked for the Federal Reserve. And he did a lot of work on this idea of government spending increasing and not having an impact on inflation, because it was such a departure from traditional thought. He published a book in 2007, right before the financial crisis, talking about this. And he coined the phrase a balance sheet recession. Traditionally, the theory is that if interest rates drop, it incents people and businesses to borrow more, and that will pick up demand to get growth going again. But in Japan, they saw a peak in their economy and their growth in their economy in 1990, and it was driven largely, I mean, that whole drive, if you remember back in the 70s and 80s when Japan was growing so quickly, a lot of it was driven by debt, by businesses and people who were borrowing money and putting it back into the economy. When that peaked out in 1990, and you saw the demand really drop off, and the government started borrowing and spending money to try to keep things up, it didn't matter how low interest rates got. You didn't see demand picking up for loans. So this chart, and this is kind of a complicated chart, so I apologize for that, but I wanted to point out a couple of things that are really key to the discussion that's happening right now, which is how can you have government debt so high without having a negative effect on the economy and without fueling inflation? And what this chart is showing us, so money supply is basically currency and your bank accounts, the balance at your bank accounts. Monetary base includes the money that is held at the central bank. So you can see in the red line, this is Japan's, Bank of Japan increasing the amounts in their deposits at the central bank, which is they're trying to push money through to the economy. This green line here is actually the bank lending. So banks, again, getting a bounce back. So with how banks make money, obviously, is through making loans. So their most profitable way of doing that is that they take your deposits, they make loans on it, they make money on the spread. If there's not a demand for the loans and you have deposits there, they need to make some kind of return on it, and they end up buying investments, and they have to be safe investments from a regulatory standpoint, and this is true across the developed world. So for the balance to be increasing at the central bank, it's basically inflating banks' balance sheets. But the underlying demand is really the loan demand. It's like, what do people really want to spend? And in this case, you're looking at that green line. So you had over a 30-year period, only a 30% increase in loan demand in Japan, despite the fact that interest rates were so low. And in the bottom chart is showing in the orange what inflation was doing at that time. So a negative number means that you actually have deflation happening in that. So the prices are actually declining as opposed to inflation. And that annualized number on the green line is basically you had loan growth of 0.8% every year for 30 years. So incredibly, incredibly low. If you apply that same methodology to the US, you can see here on the right-hand side, we saw this big spike. This was the central bank, Federal Reserve, basically coming out and saying, whatever money you need is available here, banks. If anybody's coming for it, it's there. But you haven't seen a pickup in loans on a net basis, and you haven't seen a pickup in demand. And inflation right now is running at about 1%. So there might be some questions about, is that inflation number real? Which I think is a valid question, and we usually don't know until after the fact. But certainly food prices are up, but oil prices are down, gasoline prices are down, travel's down, restaurants are down, housing prices are up. But by and large, if you take everything on an equal basis, it's up about 1% right now. And it's probably not that far off. It had been running around 2% prior to this current recession. But like I said before, when we looked at that longer term chart, since the financial crisis, demand has just been relatively low. And it's not just in the US and it's not just in Japan. We're seeing this in Europe as well. And the growth rate in Europe from a loan perspective matches about where Japan is. So when we hear about, a lot of negative news about the government debt and it is something that we have to watch. But the real issue is that where's the demand within the economy? One of the pieces that I look at is demographics. And the thing I find so interesting about Japan is that they had a peak in their working age population occur in 1890. China has had a peak in their working age population in 2013. We haven't had that yet in the US because we still have a birth rate that is above 2, but largely that's because of immigration. So I find it very interesting about the arguments around immigration right now, because if we didn't have immigration, we would have that lower birth rate too. So women who are born in the US tend to have less than 2 children. So that means that eventually you're not at a replacement rate, you're going to be declining. And we're seeing that in Europe, where the birth rates in Europe have declined below 2%, or excuse me, below 2 children per woman. So longer term, it's really hard to see without population growth, where is really the kind of end market demand coming from. And that to me is kind of the key issue going forward, and what I spend time looking at of what's really going to be driving it. So going back to how this fits in with the economy, so the annual GDP growth, so it's just the change in the rate of spending on a year-over-year basis. So this goes back to World War II. And you know, when you look at this chart, I think a couple of things really come clear to me. One is that you started to see a disconnect between the growth rates that were happening in the economy prior to the 1980s and after the 1980s. And what was happening back then is that we started shifting more towards a service economy. On the manufacturing side, we began automating so much more than we had in the past. The employment started shifting more to the service economy, a broad range, some of it skilled, some of it unskilled. And you had a lot of outsourcing happening at that point too. So looking forward, when I'm thinking, okay, what matters to me is demand. I don't think we're going back to this, volatility that we had post World War II, prior to the 80s, because even if as manufacturing comes back closer to home, we're still doing much more automation than we had before. And I would expect to continue to see this kind of moderating out, where you have lower highs in the growth, but you also have fewer recessions. A recession is any time this growth rate falls below 0. This was the financial crisis in 2008. I didn't include the drop off in the COVID because it would totally change the scaling of this chart. It was so deep, but it's already been coming back. And the question is that when it does come back and starts to normalize a little bit more, is it going to look more like this kind of a service economy? It seems unlikely that it's going to be this kind of volatility. The other things like just-in-time inventory management was happening there. We're just so much more efficient overall than we had been before. So a lot of talk about the economy and government spending, and where does that spending come from but from taxes. So this is a chart from the Tax Policy Center, which is a joint group between Brookings Institute and Urban Institute, and they have a lot of great data. And I thought it was very interesting to see how we compare from our tax revenue as a percentage of our GDP relative to other OECD countries. Just in case you were thinking about moving away after the election, one way or the other, this is what you'd have to look forward to in other countries. So the US is pretty low on the list. If the average is 33%, we're at 24%. France, Denmark, and Belgium are pretty high. Japan, is interesting since they have that that large debt rate. They're right around 32% of tax revenue per GDP. So certainly it seems like there will be a lot of pressure that tax rates are going to go up, and I don't think that's going to surprise anybody in this audience. For the other piece of it is kind of what the breakdown is and how that compares versus the OECD countries too. So there's 4 broad ways to get taxes. One is through income, including investment income. One is the Social Security payments that we pay. We call it Social Security. Other countries have different names, but everyone has some sort of it. Property taxes. So this includes local numbers. And then goods and services. So this is sales tax. And you know, if you've traveled overseas a bit, you know about VAT, value-added tax, can really substantially increase their costs if you're shopping over there or buying goods for your business. So it's a real breakdown and a lot of variation by the country. So the U.S. Down below is proportionately more towards income taxes than the average. We're about the same in the Social Security contributions, and we're much lower on the goods and services. You know, some of this is a cultural thing where, you know, we recognize in the U.S. that a sales tax is actually a regressive tax, that it hits the lower income people more than an income tax does. We're much more progressive in our tax structure, I think, than a lot of the other countries are. And that really comes through on the goods and services. So a lot of moving parts and places that can be impacted depending on what the tax changes could be if we see a Biden victory in November. And speaking of that, so Deutsche Bank did this interesting comparison from 4 different areas that do a tax analysis. And one of them is the Tax Policy Center. That's the one that's listed first, where those previous charts came from. And they did an assessment and said, okay, if the policies that are being promoted so far actually come to pass, what does that mean in terms of revenue back to the government? So the total range is between $3.3, $3.6 trillion would be raised under this tax plan if it was exercised in its entirety. So just looking down the list, the 3 big areas are increasing the corporate income tax rate. So currently 20%, taking it back up to 28%, which is less than it had been before, but still a big jump from 20. The next biggest one is the increase in the Social Security earnings cap. So that, I think it's what, $110,000 in income, you stop paying Social Security, so it would be raising that limit. And then the next one is the capital gains. So what's being proposed is that for taxpayers with over $1 million in income, that their capital gains then, instead of being charged at capital gains rate, is going to be charged an income tax rate, a normal income tax rate, and that any capital gains that you have on your death are going to be paid as opposed to a step up in basis for the estate. So lots of other smaller changes. Those would be the big 3. And so there's a question of, number 1, is Biden going to get elected? Number 2, would he be able to push through all of these changes or not? And then what does the entire picture look like afterwards? So shifting gears, we've talked a lot about the economy. We've talked a lot about interest rates and the bond market. The next piece is the stock market. From a day-to-day basis, it really is random if the stock market's going to be up or down. The news media, they've got to fill in something, but if you listen to them every day, you'd think that it was just total chaos. But if you look at longer term, there's such a strong correlation between corporate earnings and stock market prices. So, this chart is only showing from 2000 through today, but on my website, I have this going back to 1871. The correlation rate between prices and earnings are about 85%. There's no single factor that has a bigger influence on the stock price than that. And if you can see on the far right part of the chart, you've got the pricing, which this was through the beginning of September, so it doesn't have the pullback from the last couple of weeks, but it's not going to change that much. And then you see on the gray line is the earnings. So Wall Street right now, they forecast out at least 12, sometimes to 24 months out what companies are going to be earning. And if you look at how these two things are related since COVID, obviously Wall Street is looking past 2020 and they're looking to 2021 and saying, okay, we're we're betting that we're going to see a recovery. And right now what's being estimated is that we should be back to the same level of corporate earnings that we were in 2019 by early 2022. So we're still going to be growing in 2021, but we've seen the worst of it. We've bottomed out. This is what Wall Street is saying. We've bottomed out, and that we'll start to see, we're going to see a recovery from here on out. The second quarter was probably, of this year, was probably the trough. We'll see. It's, again, just like a focus on the demand side of things. This is really the key part of what your outlook is for the stock market, of what's happening from a company basis, because the stock market is not actually the economy. And I'm using in this, when I look at the stock market, I primarily use the S&P 500. The S&P 500 makes up about 75% of the overall value of the US stock market. And we have a long history for it. We can get a lot of data in it. So it's a really good proxy for these types of measures. But it is not the economy. So in the economy, if half of employees are employed by small businesses and the other half is employed by larger corporations, the companies that make up the S&P 500 are really the largest of the large companies. It's broken down by 11 different economic sectors, which I have listed here on the left. This is sorted by the value, the market value of those companies within those sectors. So you can see technology is 28% of the value of the S&P 500. Healthcare is about half, so that's largely pharmaceutical companies, is about 14%. But I included in here revenue because I think that it's really important to know that when you're looking at the stock market, not only is it not a reflection of the economy, but there's two things that stock investors want to see. They want to see growth, and they want to see profitability. And profitability, I think, is very obvious when you look at technology has about half of the revenue that healthcare companies do, and yet they've got double the value in the stock price. A big part of that is because they're the most profitable sector out there. Just the business model itself. They have asset light on the production side, a lot of intellectual property, a lot of repeat goods that are put out to you know, we have these subscription services. So it's created a lot of stability and profitable stability for these companies that are not necessarily obvious for or achievable for other sectors. And then the growth piece of it, looking at expected earnings for 2020, healthcare and technology are really the only sectors that are going to grow this year. I mean, it's a pretty low growth number, but I think it's kind of interesting. Energy is actually negative, meaning that they're as a whole will lose money this year. They have a big growth number for 2021, but that's coming off such a low base that it's deceptive because it's a small number, and right now it's only about 2% of the S&P 500 overall. So, you know, I hear a lot of people talk about, well, why is the stock market up so much when the economy is so bad? And it's because if you're looking at the 500 or the biggest companies, it's because, yes, they're exposed to the economy, but they're also exposed globally, and they tend to be more winners than losers in it. And it all comes down to, well, what do you think? Do you think that the earnings that are forecasted for it are real, or do you think that they're too optimistic about what's going to happen? And we won't know. We'll find out. So so let's just take a step back again. So we've got interest rates, inflation that we're looking at underlying demand, and then we're looking at stock market earnings. And again, I always like to have a perspective on this kind of longer term, and broken down what the returns have been in each of these categories over different time periods. It ends in 2019 because I'm only using annual numbers, and this will get updated in January once we have the 2020 numbers. But the thing I want to point out is that in the past, you used to be able to hold money in your savings account and you would be paid a yield by the bank that was higher than what the inflation rate was. And that really went away in the financial crisis. And it's forced investors to take more risk, because at a bare minimum, you want to be making more than inflation because you want to preserve your purchasing power. So it's caused investors to take more risk in order to try to beat that inflation bogey. So in the last 5 years, up through the end of last year, you've got a 3.3% return. This is the 10-year Treasury, when the inflation rate was 1.8. And you can see what the numbers are for the 10-year numbers as well. There isn't anything that I'm seeing in the economic data that would point to anything different than a continuation of this trend. Because there isn't anything that I'm seeing that is really causing a big pickup in demand. And until we see that, I would not expect to see that inflation is really going to be much higher than where it is currently. I mean, it's going to bounce around a little bit, but not the kind of inflation that we saw in the 70s and early 80s, unless something really surprising happens. Either, there's people start having a lot more children than they had before to help fuel that growth, or there's some significant disruption that happens that would cause it. But it's really, when I'm making these decisions, you have to go back and say, well, what is the data telling me? And until I see some departure from what current trends are, it's really hard to see that we're going to have, you're going to be being paid any yield in your savings account anytime soon. And even right now, money markets aren't paying anything. And it has to do with so much cash coming into the market without a lot of places for it to go that people aren't spending. So that being said, it's always good to see what are the mistakes that people make. So again, going back to how we were taught in economics classes and finance classes, we're always using these examples and these models where everybody is efficient and making decisions in their own best interest, right? So Adam Smith and the markets are, can correct everything, that it's the most efficient way of making decisions and setting up policies. But there was an economist that's at the University of Chicago called Richard Thaler, won a Nobel Prize a couple of years ago by proving that people are actually irrational in their decisions about finance. So if you look up on the internet, behavioral finance, you'll find a bunch of articles about all the ways that we make bad decisions. And I just brought up 4 of them because they're the ones that I think that apply most frequently to investors. The first one is the recency bias. And what that means is that whatever period we've just gone through, like in this case, we're in a recession right now, we've just gone through this big downturn in the market, and now this recovery that people are questioning, that has a bigger influence on our ability to forecast than if we look at a broader time period. And in order to avoid that, you need to look at a broader time period and say, what are the factors that are driving it? The next common mistake, and I love this one, is false precision. So I would, if you've ever had a Monte Carlo simulation done for your finances, I would classify that in this false precision, where the model is so complex and it covers so many different things that you become unnecessarily and wrongly confident in the outcome because it's so complex and there's so many things that it captures. And when I was early in my career and first learning to follow stocks and being an analyst, we have to build earnings models. And so we build out these very complex earnings models about what we think companies are going to be earning going forward, since it's earnings that matter for stock prices. And I found that the more complicated it was, number one, it was harder to upkeep. And number two, it wasn't giving me any better information than a relatively simple model where I could identify, say, 2 or 3 things that was really going to matter for that company, and then just test those 2 or 3 things to get a scenario analysis around that. And that's really where this false precision comes in. is to be careful not to add so many different factors and whatever it is that you're building out, that you lose sight of the 2 or 3 things that really matter the most. And for investors, the things that matter most are going to be how much are you spending, how much are you saving, and what your investment returns are over time. Herding behavior, we see this a lot. Tesla, Bitcoin, things are up. And so everybody's like, oh my God, I'm so stupid. If I'm not in it, I need to buy it. And it works until it doesn't work anymore. Or in the case of, the stock market being down and like, oh, I'm out, I don't want to deal with this anymore. It's such a big headache. Everybody's already out. I'm late, and I get out, and I get out on the bottom. And again, it's about looking at historically what's happening. Look at the fundamentals. Well, what is actually being discounted into the Tesla price before just buying it because everybody else is buying it, and you think that in this game of musical chairs you're going to be able to get out in time. You're not. The last one, of course, is loss aversion, which losing $10,000 feels a lot worse than making $10,000 or $100,000 or more. So it's there's no discounting that it feels bad. And it does impact the decisions that we make about whether or not we put more money in the stock market because, gosh, it goes down sometimes and it's just really scary. Or we sit in cash, and what we're giving up is that, we can't even keep up with inflation anymore in cash, even though we used to be able to. It's about trying to step back from the emotion of it and saying, okay, what are the trade-offs for it? Because most of the time it's not so clearly wrong or right. It's usually a series of pluses and minuses. So with that, I've covered a lot of material. We talked about interest rates, what's going to happen with that in the future, how that ties in with the economy, taxes, what government debt is going to do or not do, where do we care about in terms of looking at the demand growth overall, the stock market and how that is not really reflective of the economy, but it really is specific to those sectors and companies that are growing fast and are profitable. And then lastly, what are the things that can trip us up when we're making these decisions? So a lot of area to cover. So I'd like to turn it over to Scott and see what questions we can do.
Great, thank you, Terri. There have been some really good questions come in, and I think given our numbers, I think I'll just ask the people that submitted the questions to submit them directly. So I'll first of all, I'll ask Michael Miller. Michael, you had a couple of great questions along the way. Do you want to pick a couple that are your favorite and ask Terri?
Sure. Thanks, Scott. Let's see. I'd start with the anticipated retirement wave of boomers and small companies changing hands. Do you think that small company, to whatever extent you can weigh in on this, do you think small to medium-sized company owners will find themselves unhappily in a buyer's market within 2 or 3 years?
It really is going to depend on the sector and the industry. So if you're in an industry that has, a lot of that end market demand, I don't think you're going to have a problem, especially if you could sell that to a larger company who's looking for growth. But if you're going to if you're in an industry that the margins are already tight, and if there's pressure that it's going to be worse, then regardless of what happens in the demographics, it's going to be a harder time to get those sold.
You see, okay, I would couple that with this question with the Fed's recent announcement about free money. Is it good? You really believe that it's going to be free till 23?
The reason why Treasury bonds are considered so safe is because of the government's taxing authority. So generally when they say that they're going to do something, they have the ability to do it. No one thought back in 2010 that you'd still have the Federal Reserve buying so many fixed income securities on the marketplace. And then that was even before COVID happened. So they certainly have the capacity to do it. The things that will prevent them from carrying through with that will be largely if we have an inflation pickup. if we continue to have unemployment at high levels, they're going to do everything they can to keep that down. And it's all about trying to get that money back to the consumer. So I don't doubt that they could do it. They'll be under pressure if there was more inflation. So I don't know if people saw the reports after the Jackson Hole meeting by the central bankers that happened earlier this month. And so the chairman of the Federal Reserve, Jerome Powell, said that the Federal Reserve is supposed to balance out unemployment and interest rates and inflation. And he said, their focus basically is on unemployment, and they want to see a recovery in the economy, and they are willing to let inflation grow longer than they have in the past in order to make that happen. I hear a comment like that, and I think of Japan. And I think, okay, you're already throwing so much money into this. Where is the inflation risk? It's scarier to think about a deflation risk, right? That's the 1930s. But if you can keep that employment improving, and also want to say on the unemployment, unfortunately, it's the least skilled workers that have the highest unemployment, right? I mean, it's not the skilled workers. The unemployment level among skilled workers is much, much lower than what the average number is. So it's about trying to kind of prop up that lower income, less skilled population, because that's a really vulnerable piece. And so it's a long-winded answer, but there's a lot of moving parts with it, and the Federal Reserve is going to do everything they can to prop it up.
Thank you, Terri.
You also raised the issue of the amount of debt that we're incurring, and is there danger of, I don't really understand where that debt lives, and is there danger on whoever that debt rests with calling the loan, if you like, or taking any power that they didn't have before?
I would say no. So let's do a scenario, right? So China owns a lot of our debt. A lot of foreign governments own a lot of U.S. debt because it's considered secure. Certainly, looking at the tax charts, we have the capacity to increase taxes if we choose to do that. And the U.S. dollar is so strong and is the most tradable currency out there. I often hear people talk about, well, what's going to happen when the U.S. currency, you have a currency pressure under it. And my response is, well, where are you going to go to? There's not enough gold, there's not enough yen, and there's not enough euro. And Bitcoin isn't backed by anything other than people's belief that it has some value. So if you don't have US dollars, what are you going to do? So back to the China analysis. So China holds a bunch of debt. There is no reason why they would want to destroy the value of that by saying, we're going to sell this, we're going to dump our bonds back into the debt and sell it off. First of all, there's a huge amount of demand for that debt. Because interest rates are so low and people have become risk averse, that it's one of the reasons why the government can raise so much money, is because there's a lot of businesses and individuals and entities that want to own it. So that part of it, it's hard to see a scenario where that plays out. I think that one of the things that I've learned in investing is that whatever the majority of people think is going to happen, it's not. So, when I hear a lot of pundits talk about, I hear a lot. Okay, let me put it this way: I hear a lot more people talking about fear of inflation than I hear about a fear of deflation. So in my mind, that makes me fearful of deflation, not inflation, because people aren't focusing on the right thing. And government debt, as we can see from what is happening in Japan, is not caused inflation. And so I have a friend she's Japanese, and she has a job in media that takes her back and forth to the U.S. and Japan. And she asked me, she said, I don't understand why everybody talks about how bad the economy is in Japan, because when I go back there, unemployment's low, people are happy, they're going out to restaurants. I mean, it's a pretty comfortable life. And I thought, That's true. It's from a society standpoint, it's a pretty comfortable life. I think when you're running a business, you're always looking at, well, how do I grow? And that's really what our focus becomes. But from a society standpoint, having slow growth and stable employment is a pretty good sweet spot to be there, if we can get back in there, regardless of what the government debt level is.
Okay, thanks. Ryan, looks like he's got a question.
I do. It appeared as if you were teeing us up, Terry, to model what's happened in Japan, based on what you're showing us, and I'm just taking a stab there, and you can tell me if I'm right or wrong. But I did go back and take a quick look, and Japan's stock market over the past 30 years has not been a place you'd want to invest until maybe the past 5 or 10. So do you foresee something similar to that occurring here?
That's a really great question. So one of the things that happened through the 70s and 80s is that the valuations in Japanese stock were through the roof. So when we talk about valuations, the most common one we use is PE, it's price over earnings. So as we talked about earnings being so important to where the price is, there was a lot more money going into the market than what the earnings that were to support it. So by 1990, when the peak of the stock market happened, you had a PE ratio of 74. Now, our normal PE ratio in the US is about 16 times. Right now, it's a little bit higher. Generally in recessions, it is higher because earnings are lower. So, and investors are looking through that low earnings number. So it means that the multiple is higher. So it's around 20 right now. In 2000, when we were at the tech bubble in the US, it got up to 27 was the PE. So that stock market in Japan at a 74 multiple in 1990, it did not get back down to what I would say normal levels, normal being the rest of the developed world. It didn't get back down to those levels until 2012. So that really is what drove that stock market. But I think it's an excellent question, because if you just looked at the numbers, you'd say, gosh, are we going to have the same kind of decline in the stock market? And I just go back to, well, what's happening with the earnings? Are earnings continuing to grow or not, and at what rate? And am I willing to pay for that? Because again, there's a finite number of things that we can invest in. I mean, for all of you that are business owners, your business is going to be your best investment. That's most likely going to be your best return. And then if you think of the building blocks of what is out there, if inflation is 1%, and then historically the relationship has been that bonds will get 1% to 2% over inflation. We're obviously not getting that right now with 10-year treasury bonds. But if you look at the corporate bond market and the investment grade, the higher quality, you're getting about 2% for a 4 or 5 year maturity. And then the stock market, that relationship is usually around 4% over the bond market. Over time. Obviously, there's lots of lots of volatility in the meantime. But now you're talking about a forecasted stock market return with rates so low and growth so low of somewhere around 7% per annum. I mean, certainly on your businesses. I mean, I think that most businesses, when they're doing investments, are looking at return rates, ROIC rates of somewhere around, north of 10%. And if you're a tech company and you've got, great gross margins and attractive operating margins, it can be higher than that. I don't know if that answered.
No, I mean, your PE question is absolutely that. I didn't realize that. So you're right. That made total sense to me.
Yeah.
And Rick, you got something to say?
Terry, what you haven't gone into is what we should do about all this. And I'm just wondering, just as sort of a simple way of talking about it, the usual rule of thumb has been sort of 60% equities, 40% bonds.
Mm-hmm.
And I'm wondering whether that rule of thumb is applicable, or we should be using that today in such a low interest rate environment.
That is an excellent question, and I was kind of anticipating that was going to happen. So I wasn't sure how much time I'd have to go through everything. So I didn't. I have a couple of slides that are in the appendix. Whoops, this is not what I wanted to do. That addresses that. So, are you familiar with target date funds? they basically were put in place to replicate the old pension funds. So as pensions went away, and we moved to more of a 401k, as individuals, we were put in the position where we had to plan for our own retirement versus when we used to have pensions, and nobody gave us any tools to make those decisions. And what you saw, so pension plans and any kind of retirement plans for businesses have to file reports every year with the Department of Labor. So the Department of Labor has a ton of really interesting research about what people are doing to save for retirement, and what they're not doing. And what they found is that, this was probably like 15 years ago, is that people didn't know what to choose. And so they were just sitting in cash. And I thought, oh gosh, this is a disaster, because sitting in cash, you've got a long time horizon until you retire, and you're not making anything and you're not getting any compounding. So businesses started coming up, or fund companies started coming up with these target date funds. And they said, okay, if you know when you're going to retire, just buy this fund that has the year that you're going to retire in it, and we'll take care of the management for it. And the idea was to replicate a pension fund. So now when new employees come into a firm, many companies are having them default into a target date fund unless you opt out and do something else. So this is a target date fund. This comes from Fidelity. And this is based on the years that they're identifying as when you retire. And this is what you're talking about. So 0 here is the retirement date. The black area is the equity funds. Here's short-term funds here. And they're saying, okay, once you get close to retirement, then you're going to go really conservative. The problem with this, and this is a recent prospectus. So this is 2019 prospectus. And the problem is that these models are all based on historic numbers. And we can see from the bond market and where interest rates have gone that you're not able to keep up with inflation by doing that. And so in practice, you're better off. The other piece of that too is that we're living longer. So this idea of that when you retire, you're going to be in this, you've flipped to 40% stocks and 60% bonds, or 50-50, or having more on bonds. The bonds aren't meeting what your needs are, and you're going to be retired for 30 years. When Social Security was started in the late 30s, you started getting paid out at 65. The life expectancy was 68. So you just didn't need to have that much. Where now you've got a life expectancy for the educated class who have white collar jobs is more like their late 80s. So if you retire, let's say you retire at 60 or 65, you still have 25 years. It's not like the old days. So, I always tell clients, I know that it's uncomfortable to be in the stock market because of the volatility and because of our thinking about recency bias. And we just saw this 30% decline in a month, that is, white knuckle kind of environment. You have to say, well, it's also very highly correlated with earnings, and companies are incredibly resilient and the earnings keep going. And I'm not going to be using all this money or I'm going to be spreading out the use of that money for another 20 years or 25 years, or maybe even 30 years. When I do forecasts out, and Scott can attest to this, I go out to 100 years old because there's a lot of people who are living to 100 years old. And if you think about what the life expectancy was when your parents were born, and then where it is today, I think that it's very likely that we're going to see a continuation of an increase in life expectancy. Now, that has had some pressure in the US for a variety of reasons, but I think for the audience that I'm talking to today, the trends are still for a longer time period. So those old rules in my mind do not apply. I tend to have I'll just share with you what I'm doing. I'm not going to tell you that that's what you should be doing, but how I address this for myself and my clients is that looking at having a higher allocation to stock, which right now, by the way, S&P has a dividend yield of 1.7% versus a 10-year treasury, which is under 0.7% for 10 years, is that I have a higher percentage in stock, but I take that more conservative stock basket of S&P 500 companies as opposed to the small cap or international or a lot of other more highly volatile areas to try to minimize some of the risk exposure when you already have to have so much in the stock market. Does that make sense?
Yep.
Yeah, I think that these target date funds are just doing a disservice. I did a retirement seminar for Slalom Consulting 2 weeks ago and shared with them this chart because they use the Fidelity target date funds. And I said, the way you can get around this is just don't use your actual target date for retirement. Use an earlier one, and then you'll get that, that additional exposure. It's the same thing with 529 plans too. If you have them for your children, they are moving to bonds really quickly. When they start college, they still have another 4 years, and really if you're going to be if you don't need the money for 2 years, I try to put most of that in the market because even in the financial crisis, we had a 40%. It was 37% decline in the S&P 500 in 2008. If you bought at the peak, which was in 2007, it would have taken you until 2010 to get back to where you had been. Not many people started investing in 2007. Most people were starting earlier, but for that money going in there, it took 2 years. And so I used kind of 2 years as that time period of saying, when valuations right now, 20%, but if you base it on those later numbers, it's more like 18% or 18 times earnings. I feel pretty comfortable with the valuation, and I feel pretty comfortable with the trajectory of what the earnings are. Certainly if we ever got to like Japanese level of valuations, I just buy real estate.
So would you consider yourself a market bull? Are you bullish or what?
Yeah, I would say that anyone who invests in the stock market is at heart kind of an optimist. But so yes, I am bullish. I'm hesitant to say that because it implies that you can buy anything willy-nilly and that it doesn't matter that, that I'm as comfortable buying Tesla as I am buying Exxon. And it's not true when you look at it on a per stock basis. But overall in the index, yes, I feel very comfortable with that. I feel more comfortable with the S&P 500 than I do with the Russell 2000, which is the small cap area. And I feel okay about the mid cap space because the large companies need to grow and they tend to buy those mid cap companies in order to get that immediate growth. Because as you know, it's hard to grow organically at high rates once you get to a certain size.
Yeah, I'll just point out that was a nice balance of what I find you do is you talk about the math and the history and all of that, and then there's an element of how do I feel about it and what do I do because of how I feel about it, and I can see why in the past I was always lagging, and by the time it gets to the newspaper, it's way too late to make any decisions on anything that I would do. That's why I always felt like I could be a great investment advisor because you just do exactly the opposite of what I would feel like doing.
Another question, if that's okay.
Yeah, Ryan, go ahead.
All right, sorry, I love this stuff. So
yeah, me too. So
yeah, exactly. So I've been hearing some people lately, Terry, say, the stock market, yeah, it's going up, but one of the reasons why it's going up is because there really isn't anywhere else to invest and to get yield, right? And so I just sort of was curious, like, what your response to that is.
Yeah, I think that there is some truth to that, but I also have another slide to share with you, which is, so money markets. There's a ton of cash out there right now. So some of it was that there was cash hoarding that happened right when we started doing the shutdown. I don't know if your own companies, there were a lot of people who took their lines of credit because they didn't know when the revenue was going to start again. And you still had rent to pay and still had expenses. And so there was just a ton of cash. There was also a lot of people who sold in the stock market, a lot of institutions that sold both stocks and bonds, and they were sitting on cash. It's one of the reasons why interest rates are so low for shorter term investments like money markets or 1 or 2 year bonds. When they put all of this cash in, it overwhelmed the supply that was out there for buying a bond, or they call it a bill if it's under 5 years, or under 2 years. So you still have that money out there, and there isn't a lot of places for it to go. So what I'm waiting to see is that how much of this, and I haven't seen it yet, so if you see it, please pass it along. How much of this cash that's sitting on the sidelines are actually drawdowns from short-term loans, and so that money will go back to pay back that loan once they're in the all clear zone. How much of this is the stimulus checks and PPP loans that are sitting there waiting to be used, but there hasn't been a demand? One of the things that we've seen in the last couple of quarters is that people have been saving an extraordinary amount of money. Normally the savings rate, which fluctuates a lot, but it's been running through 2018 at about 6%. So people are saving about 6% on average of their income. It's at 35% when the number came out in July. So how much pent up demand is there? We're seeing people spend a lot of money on their houses, right? Because now they work from home. And the prices there have gone up. Lumber is a really interesting thing because lumber doubled in price from January to July. So when things started shutting down, the lumber yards were like, oh, okay, we're going into a recession. Well, I know what to do in a recession. I shut down production, or at least severely limit it, because I'm not going to have demand. Then you had people wanting to build up their houses, and you had this huge increase at a time when supply was actually shrinking. It's getting back in line right now. I mean, they're running full tilt, but I do wonder how the fires out west are going to affect some of that, because there's so many lumber yards out there. But there's always Canada across the border. They've got plenty of lumber. If we can open up the borders again and get some of that down here, so there's some real disparities. But the big thing is that how much of this money that's sitting on the sidelines, how much of it is real? How much of it is going to go back to pay down debt? And how much of it is going to be spent on things that would have been spent for the last 4 months, but is still going to be going out the door, and we won't know yet. But that being said, yeah, there's a lot of money out there, and there's not a lot of places to put it. And the stock market, the valuation, and the dividend yield that it's in right now, is still, it's an attractive place to be if your time horizon is more than 2 years. I would use that as
Of interest to this group might be the impact that all that cash now and those dynamics that you talked about. What effect does that have on potential multiples for smaller companies? Is there pressure then on finding other places, alternative places, like a smaller company?
It's really going to depend on the business and what industry that you're in. So I think that if you're in a hot industry, if you're biotech and you're pretty close to either being cash flow positive or have a pathway to it or have approval or good results, yes, you can demand a higher multiple for that, because there's a lot of people who are looking for that. If you're a small manufacturer and something that's, selling into the school market, that's going to be a lot tougher, because even after this is over with, I mean, certainly the colleges and universities and private schools and public schools, because their budgets have just been hit so hard, they're going to have a really hard time buying whatever it is on offer by the companies who normally serve those end markets. So it's really you have to look at who are the likely buyers and what is the broader marketplace looking for. But the cash is there. If you're in a hot market, I'd hold out for it. If you're in a weaker market, I'd keep going until it gets better.
Yeah. Okay. Michael Hansen, did you have a question?
Yes, I had a question for you, Terri. To what extent do you think the growing use of e-commerce will diminish the pent-up consumer demand after the pandemic passes?
I think it's a really open question at this point, because on the one hand, it's so easy to click and buy. On the other, I mean, people are getting really fed up of being in their houses so long, and there is something to be said about going out and walking down Newbury Street, or we'll see how many stores can make it that long. I think we don't know. I mean, we don't know. I mean, anything I would say would be just conjecture, is I haven't seen anything out there yet that is, we know that, the trend is that more and more gets purchased online. But as you know, I mean, online purchasing is an imperfect process already. I don't know how many returns that your families make on things that you buy, but I mean, I just bought something at a cover for my couch to keep the dogs from destroying it. And first of all, they sent me the completely wrong color. And now they just sent it to a different address. And I'm like, how can they make any money on this when they've got to eat this, the transaction cost and the delivery costs for it. And I've seen a lot of that over the last 4 months, that there's actually so much demand that it's causing some problems in there. So that doesn't really answer your question, but we don't know how long. I think that this winter, this Christmas season, I think will be really telling in terms of how far along are we on this trend. How far have we accelerated to say, yeah, it's over for department stores, or at least ones that aren't doing something really extraordinary.
Yeah, and the other strong trend is that so many businesses are shifting more to e-commerce in order to survive.
Yeah.
So that will represent a somewhat permanent shift away from brick and mortar retail to e-commerce. So I'm just wondering, normally you would expect after a crisis like this passes, you would expect consumer demand to snap back in a big way. But I'm wondering if that resurgence in consumer demand will not be as great, because so much is shifting now, both in terms of consumer behavior, but also businesses shifting their distribution to e-commerce.
Absolutely. No, absolutely. And I think it goes back to which area are we looking at specifically. If it's clothing, the companies who had both a brick and mortar store and good e-commerce, they should be okay. Ones who didn't have a good e-commerce outlet, I don't know how they're surviving. And the ones who are solely at e-commerce have had problems too. So like Rent the Runway, they weren't able to keep up with what the demand was, and then figure out how they were going to clean things to resell it. There was a really interesting article in the New York Times business section this last weekend about the publishing industry and how Penguin Random House is basically eating everybody else's lunch, because they've been investing in the e-commerce side for a long time before this happened, and has the ability to sell to direct to consumer, which a lot of other publishers didn't. And they've been involved with Amazon since the early days. So I think that it really comes down to when we're in this time period where there's so many changes happening so fast, it's harder to make generalizations about the industry. You really have to look at the companies themselves. And then there's some companies like, Home Depot and Lowe's that have been off the charts lately. Can you really replace that on an e-commerce? You can be more efficient. You can order things and then you can go pick it up, which is great for them because that's an efficient way for them to deliver the product. But, are you really going to order a bunch of plywood off of Amazon and have it delivered to your house? Probably not. So it really depends. One area that I think that we are seeing evidence of a potential big bounce back is cruise lines. So apparently cruise lines, despite all of the issues that they've had, have like record bookings for 2021. So once things kind of open up again, people are looking to get back out on those boats. I don't know why. It won't be me, but there is that pent-up demand.
Have you tried the buffet? Mark, we'll go to Mark and then Victoria, and then I'll go back to Rick, and that should take us home. We got 7 minutes left. So Mark.
Okay.
Yeah, so Terry, this has been great. You've touched a few times on people's investments, right, in their own homes, and obviously what's happened in the real estate market also this past year. I guess I'm just curious if you see that as a potential option for people who are looking to invest and kind of evaluating kind of the market versus, investment property. So
Yeah, so I really like real estate as an investment when you're going to buy the property and you know it and you've got the cash flow versus buying REITs. I'm not as crazy about the REIT market because you just, as an investor, you have so little control when they change direction, and you don't know until after the fact. So I just, I would rather have, a 2-family house or a 4-family house that I know where the cash flow is coming. And yes, I might have to manage the vacancies, but there's work involved in it, right? It's not a passive investment. But I think it's a really great, secure investment when you know what the property is, and you know who can fill it. It's the sort of thing that I wish I had bought 2-family homes back when I was, in my early 30s. I mean, that would have been great as long as it was in the right place. So, we have a view of what's happening in the Boston area, and it's been a great real estate market for a long time. Wasn't always, but it has been a great real estate market. I'm from Ohio originally, and the issue with real estate in Ohio is that the cities just keep expanding out into farmland, and there's endless amounts of farmland. So the real estate prices there pretty much keep up with inflation, but don't exceed it. Versus the coasts, the real estate has really been so strong that it's been a great inflation hedge, and it's just been a great investment overall. So that whole location really does matter when you're looking at it. And I love it as an investment. It's not passive, and the right place at the right time is ideal.
Okay, thanks, Victoria. And then Anne, I see your question. That's probably a whole nother session, but if we can get there, we will. All right, Victoria.
Thank you, Terry. This has been great. So it seems to me that with the exception of this year, almost every election year has been really tough for our business because it seems like everybody's just so distracted, and regardless of who's going to win or who does win. And am I making that up, or is there any actual historical evidence that the economy does go under stress on the election years?
It only goes into stress when there's also a recession. Okay. So I have, again, on my website, I have a report called the Market History Report. And it goes back to 1928, and it will have the returns for the S&P 500, the 10-year Treasury bond, cash, inflation, and then events that were happening for each of those years. And so I identify every year that there's been a recession and every year that there's a presidential election. And it's much more correlated. Down markets in the stock market are more correlated with recessions than with presidential elections. It just so happens there's usually a lot of economic tension that's often happening around elections, but if it's not in a recession, it doesn't have an impact.
Thank you.
Yeah, sure.
However, I think that was kind of to your question, Anne.
Yeah, I mean, basically I was just saying, because I mean, I'm on, different groups, networking groups, like, I'm sure a lot of you all as well. And I've heard that from other people in business development saying that, their prospects, that everyone's in this kind of like wait and see mode based on, the election, whether it's manufacturers worrying about tariffs, whether it's, real estate. I mean, they're all kind of, they're hearing that, or they think they're seeing that, there's a wait and see type of attitude towards the election, and then therefore that they're not able to kind of close more of their business. But I just didn't know, but that's a good, I'll take a look.
It might be, it's the data that I'm looking at as annual data. So it might be that they are waiting until after the election, but then we still have almost 2 months before the end of the year. And so then decisions will be made. I don't know. I'm just trying to think of how that would fit together.
Right.
You know, I've been talking to people too about, well, if Biden wins, is the market going to be down? Probably. I mean, so when Obama won in 2008, the market was down a lot on his election. It was back to where it was prior to him being elected by the time he was inaugurated in January. So, you know, one of the theories that I'm hearing this year too is that if Biden wins, because of the concern with the increase in capital gains taxes, that we'll see a lot of selling between then and year end, because they'll want to be that 20% capital gains rate, as opposed to risking that going up into 2021 and having it retroactive to the beginning of the year. So there might be some selling pressure there. There usually is some selling pressure for year end anyway, and it probably will be exaggerated this year with a Biden win. But I don't think that changes the earnings, you know, at the end of the day.
Right. Rick, I think you had something to share.
Yeah, no, I had asked Scott if he wanted me to share this with you. So in the middle of October, and Scott can get you the details on this, distribute this. Middle of October, I'm hosting a program for the Harvard Business School alumni on with Jeremy Siegel, who's one of the leading academic scholars on the stock market. So
He's great.
Conversation with him, and it's interesting just in this era. So we're actually having both the Harvard Business School and the Wharton alumni groups here in Boston, in New York, in Philadelphia, and DC are all going to be on this call. So it's going to be, I don't know how many people are going to be on it, but it's going to be a quite large. And he's Terry, I'm sure you can say that he's really a very engaging speaker and expert. And anyway, so it's going to be about what the outlook for the stock market is and what the implications for the election are and all that sort of thing. So
Send me the link and I will spread it around. Thanks.
Okay,
Thanks,
great.
Rick. And thank you, Terry. As always, you know, you address both sides of my kind of concern. I feel much better about. I probably sleep for a couple of nights now. Not worry so much about what I can't control. So thank you so much for that, and thank you for your help in general with our situation. And let's hope that we're all here again next year. Maybe not on Zoom, but talking about the
In
great
person will
things
be
that we
better.
do. Yeah, so much better.
Great.
Thank you
All
so
right. Well,
much.
thanks everyone. I appreciate it.
All righty. Take care.
Thank you, Terry. Thank you, Scott.
Okay. Thank you, Michael. Bye-bye.
Bye-bye.
Thanks again.
You.
So long, Bob. Looks like you're in church there. You're muted in church.
Yeah, well, you're supposed to be quiet in church. Wait a minute. I'll change it for you. There you go. Wait a minute.
Too much technology there, Bob. Oh, there you go. That feels better.
That better?
Yeah.
Thank you. I enjoyed the presentation. Thank you very much.
Oh, great. Thanks.
Thank you, Bob. Michael, did you have another question?
Oh, no, I just wasn't sure if the call was ending or not. So very interesting presentation and discussion. I very much enjoyed it.
Great.
Thank you.
Thanks.
Good. Thanks, Michael.
Thanks. Have a great day.
You too.
Bye. All right.
Nicely done. Nice job.
Great. Great. Do we want to take it off recording?
Oh, good idea.